Take a look at this chart. It shows that Warren Buffett sold about $34 billion worth of stock in the last 3 months alone. And if we zoom out a bit, we can see he sold a total of $130 billion in just the last year. In the second quarter of this year, he sold $75 billion, another $20 billion in Q1, and $1.6 billion in the last quarter of 2023. These figures are derived from the quarterly Berkshire Hathaway financial statements. Buffett's equity investments decreased from $319 billion to $272 billion in the last year, a $47 billion decrease. But his stocks also increased in value during that time, by $20.5 billion in the last quarter alone, and $83 billion in the last year. So once we factor that in, he's been a net seller of $130 billion of stock. And that's net. So instead of deploying that money back into stocks, he's been building his cash pile. Buffett's now sitting on $325 billion of cash and short-term investments, the highest level ever. But this isn't the chart we care about. After all, it's totally normal that Berkshire's cash pile would grow as the business grows. This is the chart you should care about. It shows the percentage of Buffett's assets that are sitting on the sidelines in cash and government bonds. It's now at 28%, the highest level by far since the early 2000s. And particularly in the last few quarters, he's choosing to keep a much bigger percentage of his money out of the stock market. So the question is, what has he been selling and why? A quick shout out to Stockopedia for sponsoring this video. Their platform gives you access to institutional quality data on over 35,000 stocks across multiple global markets, which will help you uncover hidden gems and potential multi-bagger investments that others might miss. Right now, I've got an exclusive discount for you if you use my link or my promo code in the description below. So the first question is, what has Buffett been selling? Well, in the latest quarter, almost all of the $34 billion of net stocks that were sold was the sale of Apple stock. The value of his Apple investment was recorded at $69.9 billion, significantly lower than the $84.2 billion value recorded 3 months earlier in the second quarter. And that's despite Apple stock rising significantly in between. To see exactly how many shares he sold, we can pull up Apple on Stockopedia and look at the major shareholders page, where we can see Berkshire sold another 100 million shares in the third quarter, about $20 to $23 billion worth. And that's just in the last 3 months. 12 months ago, Buffett was holding 915 million shares of Apple. Now he has just 300 million left. As a little side note, this continued selling actually took a lot of people by surprise, because at the end of the previous quarter, he was holding exactly 400 million shares, the exact same number of shares as his Coca-Cola investment. Buffett has famously held onto those 400 million Coke shares for decades. So to Buffett followers, it looked like he was signaling that he had finished selling Apple too, but apparently not. So the big question is why? And there's actually a couple of reasons, but this chart very clearly demonstrates the first reason. Until the recent selling, Apple was a huge and growing percentage of all of the Berkshire Hathaway businesses and investments. In the middle of 2022, the Apple investment reached a whopping 17% of total assets. And check this out, by the end of 2023, the Apple investment was bigger than all of Buffett's other equity investments combined. Apple has been an incredible investment for Buffett since he started buying in 2016, but Buffett probably didn't like that the future returns of Berkshire were becoming dependent on a single stock. While certainly he hasn't shied away from holding a few big bets in the past, as he's gotten older and his remaining time at Berkshire has gotten shorter, he's increased the emphasis on preserving the wealth of his shareholders, many of whom have held the stock for decades. But concentration alone is certainly not enough for someone like Buffett to sell billions of dollars of stock. Which brings us to reason number 2, the price of Apple stock. It has become a lot more expensive in the past couple of years. And today, Stockopedia gives it a very weak 11 out of 100 rating for value on its stock rank system. These ratings are a simplification of all of the financial data. The value rank, for example, considers the stock's earnings ratios, asset ratios like price to book value, and income ratio like the dividend yield. So while Apple scores an impressive 93 for the quality of the business and 91 for price and earnings momentum, for value investors like Buffett, the business must also be cheap. Apple has a forward PE ratio of more than 30, and even when you factor in expected earnings growth like the PEG ratio does, It's a 2, which is still high. Back when Buffett was first buying Apple in 2016, it was trading at a price-to-earnings ratio of around 10. Today, you're paying 3 times as much relative to earnings, and you're most likely buying a company with far less earnings growth in front of it. Back to Stockopedia for a second, these traffic light color bars indicate how Apple compares to the rest of the industry and the whole market. Lots of red and orange is not good, which, to be realistic, is what you would expect for a high-quality company like Apple. Apple produces huge returns on capital, has excellent margins, low bankruptcy risk, a low earnings manipulation score. I could go on. And it's for those reasons that Buffett isn't planning on selling the entire Apple position.
Have you or your investment manager's views of the economics of Apple's business changed since Berkshire first invested?
No, I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now.
And it was at the same shareholder meeting from earlier this year that Buffett revealed the next reason he's been dumping Apple stock.
We are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and they can change that percentage. I would say with the present fiscal policies, something has to give, and I think that higher taxes are quite likely. And
the US corporate tax rate is currently 21%, the lowest it's been in 80 years. For most of the past century, corporations have paid a tax rate of somewhere between 30 and 50%, which makes a big difference when Buffett sells a stock and pays tax on the capital gain. Take Buffett's selling of Apple this year. He's realized a capital gain of over $100 billion. The difference between a 21, 30, or even 50% tax rate is literally tens of billions of dollars. And there's other good reasons to expect that tax rates might be going up in the future. The US national debt is currently $36 trillion, and it's been rising because the government has been consistently spending more money than it collects in revenue, leading to a deficit that needs to be paid for by borrowing money. Governments can get away with this for long periods of time, but each year the interest payments on that debt get larger. And one way that governments have reduced their deficits in the past has been to raise taxes, particularly on the wealthy and corporations. But if all of this selling is simply about Apple becoming too big in the portfolio, Apple becoming too expensive, locking in capital gains for Apple, if it's all really just about Apple, then why hasn't he deployed the cash into other investments? Berkshire Hathaway is sitting on the highest allocation of cash since the early 2000s. Well, first of all, this isn't actually cash. All the headlines say Buffett's cash pile this, cash pile that, but it's not like this money is just sitting there doing nothing. Of the $325 billion everyone refers to as his cash pile, almost all of it, $288 billion, is investments in US Treasury bills. In essence, this is lending money to the US government for a term of 1 year or less to earn a fixed return. At the moment, that return is about 4.5%. So while one way to look at Buffett's cash pile is that he has nearly 30% of his assets out of the market, another way to look at it is that a risk-free 4.5% return is just better than any stock he could buy with that money. And we can actually compare stocks broadly to bonds in this way. If we flip the price to earnings ratio, we get the earnings yield, in this case of the S&P 500. The current earnings yield of the S&P 500 is actually below the risk-free government bond rate of about 4.5%. Now, obviously, it's not that simple. In the case of the S&P 500, the earnings are expected to grow, so you'd earn the yield plus the benefit of the growth in profits. The US bond, on the other hand, will definitively not grow its earnings. It's a fixed income investment, so what the yield says is what you get. But there is one other thing that's really important. While the bond's return is fixed, you also sidestep the risk of a sudden stock market crash. And if there was a crash, it's pretty likely that interest rates would be lowered, which means the value of the bond you own would go up in price, and you could sell it and use that cash to buy cheaper stocks. Don't misinterpret this as Buffett trying to time the market by sitting out and waiting for a crash. This has always been a terrible strategy. The value investing approach is to look for opportunities in the stock market and compare them to different places you could invest the money. This means comparing stock to stock, but also to fixed income securities like US government bonds. And if the return you could earn from a stock isn't much better than the 4.5%, 4%. You might prefer a guaranteed 4.5%, plus the insurance you're effectively buying yourself if the market was to crash in the near future.
But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive.
So reducing exposure to an expensive stock, taxes, and a lack of opportunities are the main reasons Buffett is sitting on a lot of cash. But that doesn't mean he'd be doing the same thing if he was investing a much smaller amount of money. Even if a company perfectly met Buffett's investing criteria, if it was worth, say, $1 billion, he can't invest in it. So his assets will trend to a higher percentage of cash over time, but that doesn't mean yours should, which is where my favorite Stockopedia feature comes into play. This is the Warren Buffett stock screener. It filters stocks based on the academic literature of his investment strategy and can help you mirror his approach. The stocks it screens for have performed really well in most markets. It's outperformed the S&P 500 in the last 5 years, and in other markets, it's crushed the indices. You can see the filters of this particular screener is using things like return on equity above 15%, growing profits, and margins higher than industry competitors. There's also 2 other screeners around Buffett's principles and other guru screeners for quality, growth, value, bargain, income, momentum, and short selling investing strategies. You can of course also create your own custom screeners using more than 350 metrics, plus a bunch of other great features. If you're interested in unlocking a world of powerful insights and cutting edge tools, my audience can get a 14-day free trial on any annual Stockopedia plan, and there's currently an exclusive offer available. All of the details are down in the description below.